nearly banging on the door of the end of the month, the end of the quarter, and on $80 on Brent, but not quite getting over the hill on that one, banging our head on 79 at the moment. Little change this morning in early trade in Asia. But what isn't hanging around is there is now another bull market headline. That NASDAQ only wants to do one thing with $8 trillion liquidity published, posted, printed by the Fed over the last decade. It all has one home at the end of the day, and that's the terribly acronymed FANGs. Is it FAM? Or they've changed all their names now, alphabets and all metas. They can't do that FANGs anymore. But nonetheless, that's the story this morning. NASDAQ in a bull market, which ultimately means it's up 20% from its low, yes, on December 28th. So it took essentially 3 months to get back up on the horse, and here we are, 20% up, Nasdaq. Let's go to New York, where the epicenter of the universe always is. Or actually, Mike, actually no longer in New York, now in Florida, less the epicenter, but still that the crux of all the information. Mike McGlone with Bloomberg Intelligence. Is this indeed a bull market?
No, I'm glad you mentioned that NASDAQ pop. I saw the headline that NASDAQ's reached a bull market, and then you read through it because it's recovered 20% from the low. And that's a classic sign a trader says, okay, it's time to sell. When you see it hit the pop-up press like that, and I see Rachel and Osama nodding, it's just a classic case. So this is a bear market rally, in my view, in all markets. And the key fact remains that there have this banking crisis that's supposed to be over, yet the main reason for the banking crisis was the Fed and most central banks on the planet raised rates so fast. We forced the banking crisis, we forced the duration mismatch and issues, and they're still raising rates. So to me, this is an early days of what I call a global economic reset, a significant one. And they're seeing good indications of that happening from markets. Now, inflation is still sticky. If you look at backward-looking measures, we look at forward-looking measures like commodities. The Bloomberg Commodity Index has dropped 30% from the peak. During the financial crisis, it dropped 50%. So it's still going. Natural gas has dropped to its cost of production. The prices have first started trading in 1990. That's when futures started trading. It's dropped 80%. That's an indicative of deflation forces are accelerated. And now we still have central banks still tightening into a bank run. So I look at this as the rules of long and variable lags are just starting to kick in. I fully expect WTI crude oil is more likely to go towards 40. It's very unlikely to make a new high above 82 this year. And that's simply following things like natural gas and lumber at a normal trajectory in a recession, as suggested by an inverted yield curve. And that's one thing you have to be very careful about in most bear markets is you get these massive short covering rallies. They make you lose your hair. And I think prudence is more important. And I hate to play the doom and gloom, but just pointing out facts of how this is. Remember, it's only been about a year, a little bit more than a year when the Fed first started hiking and we had the Russians' invasion of Ukraine.
Let's welcome to the table Rachel Ziemba, founder Ziemba Insights, adjunct fellow at the Center for a New American Security. Rachel, I wanted to get your comments on a sort of what I think is kind of a moment of note in the bigger narrative that we've all been talking about for a while, that NOCs are going to lead the future of global oil supply development, that incremental new demand, new supply rather. We saw this week Saudi Aramco announce a fairly significant investment engagement, double refinery into China. And now for the first time yesterday, the day before, ADNOC bidding for assets overseas in the Med. Your thoughts on these developments? Do they add up to anything? I know you do follow the NOC space well. Your thoughts?
Yeah, so I think what's interesting to me, so we continue to see NOCs, particularly from the Gulf, investing abroad. The China-Saudi link up, which I would say is just the latest, I think is interesting to me because it is really in the refining and using of the fuel space. It's not necessarily new exploration, and it's a wise. It makes a lot of sense as Aramco going closer to where the consumers are, wanting to get a piece of what has been this larger development of refinery capacity in China, in Asia. And so I think it's both a shift in a sense for, sort of Saudi Aramco. But I think this, if anything, is more about trying to expand throughout the energy value chain, and the like. So, I mean, I think if anything, we continue to see the NOCs perhaps being less constrained by concerns about the eventual environmental bill. But I wanted to add something to Mike's points about inflation and the like, because I'd be remiss not to mark this morning by pointing to yesterday's release from the Dallas Fed of the sort of increased costs in the U.S. oil patch. It's some of the best data that the U.S. Federal Reserve System releases. Very good sort of data, survey data.
Yeah,
and
we have
really
we have it in the digest today. I just draw people's attention to it, which is the what Rachel is referring to is the Dallas Fed energy survey, which it publishes every quarter. You'll find it on our daily digest today.
Yeah, so I mean, you guys will capture everything that moves the sort of energy market short and sort of long term, but just really sort of highlighting it. It won't come as a surprise to anyone who's been tracking this sector or other sectors. We have seen this sort of cost pressure, this challenge is accessing the right sort of skilled labor that depends by a sort of sector. And so as a result, I think I end up in a camp somewhat similar to Mike's, maybe not quite as, sort of bearish, but of saying that I don't think that the Fed and central banks are finished hiking. And so I think you end up in a circumstance where the market optimism has been, at least in part, about really pricing in a lot of rate cuts. And I don't think that's happening. And that sort of brings us back to a question mark of the other big question driving the energy markets that links back to your NOC question, which is how strong is Chinese demand going to be? And maybe on the energy space, that's been picking up. But overall, the consumption indicators out of China, this is not sort of a very strong sort of pickup in demand, at least not yet.
Where you'd certainly see their appetite is clearly in all things Russian oil imports. We've seen both India and China. China, I think in January and February, had close to 20%, near a record of its oil imports, which is generally above 10 million barrels of oil a day. So you're talking close to over 2 million barrels of oil a day imported in from China, importing in from Russia, and availing of that nice cheap crude. But one area that isn't doing that yet is Pakistan. And let's welcome Osama Rizvi, energy and economic analyst from Primary Vision Network. The headlines that are going out now is, Osama, that Russia's actually getting annoyed at Pakistan for their delays in buying their nice cheap crude. Your thoughts on that story and where Pakistan's opportunities going now that it's received a little bit of a support from the IMF?
Yes, so that is very interesting. Actually, it was on this very podcast that I mentioned about 6 or 7 reasons, technical, diplomatic, economic, and otherwise, that would make it a little challenging for Pakistan to import Russian oil. I still maintain that that would remain, a far-fetched thought. First of all, I think the primary reason for that is that we still haven't signed a staff level agreement with Russia or with IMF. So naturally, these are 2 different camps, and we don't want to we don't want to disappoint US and IMF. So that's why we are keeping it, on the back burner for the while. Secondly, even if you look at it from the technical point of view, there needs to be an investment in the current refineries in Pakistan to the tune of billions of dollars before they become capable of refining the Russian grade, right? So from past decades, we have only been more than 60-70% of our oil have been coming from Middle Eastern vendors. Hence, the refineries have been, they have been built to process that grade of. And then you also have this issue of higher freight costs as well. And Pakistan, like many other countries from the developing world, they are cash strapped at the moment, and we don't really look forward to add more cost to it. Anything that add more cost to our national exchequer. So these are the reasons. I still believe it. The news, all of this development was more of a thing, trying to take the attention off the political, arena. There is a lot happening, and I believe it will remain like that. I would also like to add, additionally, on what Mike and they were saying about the global economic conditions and where do we lie. I tend to believe that from a bigger picture perspective, the global economy is oriented. It's perfectly fit for a bearish case for every commodity. These hikes, I think they're temporary. You look at
which hikes now are you talking about?
The petrol price. Let's call crude oil.
Crude oil.
Hiked, yeah.
Back up towards 80.
But if you look at the CFTC or ICE data, about 115 million barrels of various positions were built last week. About 140-something million barrels of positions were sold week ending March 21. So you see the bearish sentiment is building up. Of course, this is the paper markets. In the physical markets, we don't see any signs of a supply crunch. Rather, data from Fujairah shows that there was a 10% increase in stockpiles last week. So I tend to believe we might see these retracements, but the case for a lower oil price below 50 remains stronger than a case for $100 oil price, at least for this year.
I think even Goldman Sachs would agree with you. The big bulls at Goldman Sachs have even come off of their $100 perch. Mike, I wanted to I was intending to come back to this Dallas Fed Energy Survey. Rachel jumped the gun on me there. There's a lot of content in it, there's no doubt, published yesterday, and I highly recommend it, again, on our daily digest. There's a few things to pull out from it. One is oil and gas expansion production in the U.S. stalling in the first quarter, and a few other notes. I don't know if you've had a chance to look at it, but just addressing that one piece, the U.S. was a very big savior on the gas side, LNG for Europe last year. Still, the outlook is that it will continue to be that. But where do you see, what did you pick up from this report, or some indications of U.S. oil field production?
It's a known. I haven't read the report yet, but it makes sense. In addition to costs, I like to ask myself, in what part of the world the costs not increase, potentially as U.S. money supply increased 40%, and that's certainly the case in the Corn Belt. But I look at it as the most significant factor is supply is pretty stable, it's demand. And in a recession, demand globally usually drops about 5%. And that's what happened during the last recession. I think it might be worse this time. The key thing we pointed out about this time last year is around June is when U.S. unleaded gas demand peaked at the peak of the driving season, right in May and June. It's still heading lower. And part of the reason mainly it peaked was because of price. It's the key thing to remember here is price is one of the #1 drivers of demand, and that is on its way down. We basically have a bear market commodities. That's the key fact to point out right now. Commodity index down 30% from the peak. The key question is what stops that downward trajectory? Not Fed tightening, as Osama mentioned. I mean, how long is this tightening going to last? That's the key thing that's happening in a macro sense, making everything else like supply and demand of crude oil looking like a 5 on a 1 to 10 scale when we have the most central banks on the planet still tightening as we're tilting over into a recession. So I look at what you mentioned is it's somewhat of the noise of the markets you get from reports and things. That the macro is overwhelming. And the key thing is when I publish my energy outlook for the month of April, which comes out in a couple hours, the key point I'm going to make is crude oil, most commodities are in a bear market. They have one key thing that might save them. That's a buoyant rally and continued rally in the stock market, because the correlation between crude oil and the stock market is the highest ever, 40-quarter basis if you go back 50 years. And it looks like everything is going to roll over. The problem is if stocks don't roll over, the Fed's going to keep tight. It's lose-lose for the macro, which is my key point. So I'm bullish gold, and I'm still bearish crude oil and copper. And key thing I'll end with on that note, if you look at the number one measure of economic activity from commodities in the planet, it's copper. And the dollar price of copper at $4 a pound is almost the exact same as the S&P 500 if you divide by 1,000. They've been tick for tick since 2015. Looks like they're rolling over in the macro. Key point is I like to make, and I can't overemphasize enough, is the Federal Reserve, world's largest central bank, is still restraining and tightening, and it's a stated goal to increase unemployment, which means a recession, which means typical drawdown in crude oil from the peak, and crude oil and commodities is at least 50%.
Well, the other interesting headline that we picked up overnight on that tightening question, which is getting in the weeds of M2 money supply, but U.S. money supply falling at the fastest rate since the 1930s. I mean, these are indicators that one has to pay attention to in the context of the bigger picture here. That tightening is becoming quite substantial, and the indicator of that, I mean, from a money supply point of view, it supports the narrative of this tightening cycle coming to an end. If I'm not sure if it points to it coming off in terms of will we reach this plateau, or as the markets are indicating, will we decline? But Rachel, I wanted to bring in your thoughts on the other story that was moving markets a little bit over last week, was the idea that the U.S. government backed away from its commitment to refill the Strategic Petroleum Reserve when WTI dropped below 70, or was around 70 as was previously announced. Your thoughts on them backing away from that, if indeed that's what's going on, and its relevance?
Yeah, so I think they definitely didn't do the work to actually get the mechanisms ready to be back in the market buying, to really establish this put, right, or to establish this range that they'd indicated. I know part of the issue was not necessarily, sort of dealing with Congress on already mandated sales for sort of fiscal reasons. But as I think a few people in the marketplace said, if you're gonna have a put, you've got to trust it, right? And that sort of dynamic. Now, of course, you could make an argument that the Department of Energy might not have taken this opportunity to refill at an affordable price, but other U.S. government actions, including those of the Fed and the FDIC, by helping to ease some of the immediate systemic risk concerns, have brought in a bit of a floor. But I think it's going to be really important I expect we'll see in the coming weeks and months a little more clarity on what the DOE is really going to do. I think there's some divides within the administration on exactly how to do that.
What does it do for the markets, though, when they back away? I mean, the idea that, you want to be able to believe what the government's saying or what the Fed says, the forward guidance and all of that. The fact that they made such a very public announcement regarding refilling the SPR at 70 on WTI and now backed away from that, how does that impact, do you think, the market's outlook?
Yeah, so it definitely means that they won't. I think it adds to downside risk if and when we have sort of new financial stress, and I think it, and that I think means there might not be, there's not that sort of safety cushion sort of to the same extent. And maybe it brings back the sort of dynamics and question marks back to OPEC's ability to sort of act as a cutting stabilizing force on the downside, where they tend to be sort of somewhat more effective than adding supply when things are strengthening. But yes, it definitely does not help U.S. credibility on the energy front. And I think the fact that it's come at the same time that there's this issue about the IEA data adjustment factor. I mean, this is getting really in the weeds on sort of the details, but a lot of us who watch closely exactly how much the commercial draws, exactly what the supply and demand are, I think it sort of just adds to market questions. But I think ultimately, this is also something where there's a lot of work to be done if the U.S. is really going to use the SPR as a balancing tool on sort of both sort of sides of the market, and I think they really missed an opportunity.
Yeah, you would think. I
In
mean,
that way, clearly.
we all maybe have missed that in a sense that, but according to maybe some thinking that this will reverse downward again. Osama, I wanted to get your thoughts on the geopolitics of what we've seen recently, the kind of backdrop the market having been quite a dominant theme of impacting the market, and I wanted to. They become so confusing to me. I mean, it's hard to identify where their relevance is to the market. We have Saudi-Iran rapprochement. We have Russia and China rapprochement. We've got India and Russia, becoming inseparable. I mean, India is Russia's outlet for its significant amount of its oil now, a critical market. Historical relationship between India and Pakistan are not generally regarded as positive. I'm just wondering, how do you, sitting in Pakistan, look at these geopolitical changes? I would even mention Israel seemed to be in some level of divorce from Washington, given all of the political earthquakes going on there. But are we seeing a change of note here, or just a lot of noise and substance remains the same?
Well, it's very interesting, and I have been following this also very keenly. The fact is that I have a little bit bias towards China, right? So I follow China, what's going around there, and this also very ties neatly to the global markets right now, at least for the coming months. What's happening is that we are seeing, on a bigger picture scale, we are seeing China rising as a dominant power, at least in the Eastern Hemisphere. Right. But that sorts of, ties in with what is happening between US and China these days. That does not make it, the mainstream media isn't covering it a lot, but they are to some extent. But the war of words between US and China has been going on for quite a long, it's been a few months. Recently, about 29 companies, if I'm not mistaken, were also blacklisted or added to the entity list of the US. Pakistan and other countries were also sort of reprimanded for dealing with those companies. So I think as China grows or becomes more prominent on the international arena in terms of even showing its diplomatic power, I think the chances of another round of trade war, or another diplomatic skirmish between US and China becomes more. The likelihood of that increases. So if that happens,
where does that? I'm quite keen to get your sense of where does Pakistan sit in that? I mean, historically, Pakistan and the Gulf oil producing states were intrinsically linked as political partnership. Most former Pakistan ex-politicians take their retirement in this corner of the Gulf. I'm just wondering, is that relation still a bedrock of the region, or is that now changing as well, with India getting much closer to the Gulf and so forth?
Yeah, I think it's very interesting, and it requires a lot of, there are so many moving pieces to it. Yeah. But I subscribe to the ideology of non-binary thinking, right? Especially in policy making. So for a country, and especially for a country like Pakistan, we have to be like that tightrope walker. We have to balance our sides. We need Russia for our falling gas production. That can be a buffer. But we need United States of America to save us from getting bankrupt. We need IMF for that as well. We need European markets, because our textile sector, which accounts for more than 60% of export earnings, the largest market for our textile sector is Europe, not China. Our biggest trading partner is still US, not China. But of course, we need China's support as a diplomatic counterweight to the rising power and rising economic and diplomatic power of India in the region. So Pakistan does not have this package. We have to be sort of a friend to everyone, and we have to also work on our domestic front a lot to improve ourselves. So we don't have. We need to maintain the optionality in our foreign policy. That is what I would say.
Let's go to the survey question and take the this sort of bigger trend. The Fed rate hike cycle is no longer relevant for oil markets. Agree or disagree? there's a lot loaded in that short question, but nonetheless, Mike, I wanted to bring it up and to sort of tackle this outlook. Is this so-called banking crisis over in the US? We've seen sort of counterintuitive or sort of counter conflicting signals. We have gas Henry Hub dropping below $2 yesterday, which I don't think it's been for quite some time. You know, that after the bumper, it was at $10 the last time I really paid much attention to the price of Henry Hub. And we also have the NASDAQ going into a bull market, and the banking crisis is over. Where is America going ultimately, the world's biggest energy consuming nation?
And also a net exporter. That's really changed since the last recession. And that's what people forgot when I pointed out natural gas was too expensive at 10. Now it's probably getting a little cheap around 2. But it's a good leading indicator for what to expect in fossil fuels. They're the most autocorrelated assets, maybe next to agriculture, and they just went too high. They helped spike the inflation that baited the Fed to tighten too much. And it's the most significant factor on the planet that the Federal Reserve is still tightening, and that to think that the banking crisis is over is just simply silly. Because what was the main reason for the banking crisis was this high velocity hiking of rates. And what did it do? It hurt a lot of people's duration. They were too long at treasuries and maybe to move too far out in the curve. It's also forcing a major shift there's a bank run that's going on in this country that's unprecedented. Get your money out of the bank where you're earning nothing and just buy a T-bill. Now, when the 2-year note reached 5%, that was a significant signal of a major flight. Now around 4%, it's still a major flight. It's virtually guaranteed. And I hear it everywhere in this country is just get out. It's certain if you're a boomer, you buy treasury bills. Thank you very much. So to me, this is the early days of a very 1929-ish scenario, just pointing out facts. And it's a stated goal of the Fed to increase unemployment, which means almost a guaranteed recession in this country, which means that there's going to be a major shift lower. And the forward-looking markets are already starting to price it in, mostly commodities. The key question we have to ask ourselves is typically what happens for this to end. You need a much lower plateau in risk assets and significant central bank easing. Neither are there yet, and we're just in the process of going there. And I like to ask myself is why even expect, short term you might see bounces, but why even expect this to stop until you see significant shift towards easing in central banks? They're still tightening. That's the 10 on a global scale for
What is your outlook, Mike, just to sort of lead on from that, of this divergence between the market and the Fed, the idea that the market is forecasting fairly immediate and dramatic rate cuts?
The market's going to be right.
Yeah,
the market's going to be right, because the key thing to force that to happen is risk assets have to go down. So the number one missing link right there is the stock market bouncing. Once it rolls over, and I didn't say if, it should be a matter of time, then the Fed will have to ease. The key point here is the Fed will never ease with the ease they have in the past because of the lessons of the inflation they created during the last easing cycle, which was during COVID. So that to me is what the difference is. That's part of my 1929 great reset scenario. And the key questions were just, the thing is we're seeing right now in equities is just that short covering bonds. The tilt downward is just going to be a matter of time.
I promised the table in London when we all came together, of all of our commentators, to James McCallum, that we would read out notes in the webinar chat room. And so I'm going to read his note, but I cannot understand it. Sorry, James. The recent further hike in Fed rates rather than a hold or cut shows the Fed are not currently spooked by the bank situation and are sending out that message. That seems, I'm spooked by it. I'm sort of trying to get my head around what that means. Rachel, your closing thoughts on the outlook for the U.S. economy. We've gone away from this banking crisis, everything's over, party time again, full employment, too many jobs that can't even be filled. The gas is at under $2. There's no hard landing here, is there? I mean, Mike's painting one, but ultimately all the signals seem to be still they're going to be buying a lot of energy in America right through the summer driving season's only around the corner.
Yeah, so we're definitely not at a hard landing yet. And I think that's what James was getting at in his comment, right? The fact that the Fed went for this 25 basis point hike. They're sort of signaling on. They didn't want to send a message.
Recent further hike. Okay,
yeah,
right.
That's my read.
Now I got it. Right. Yeah. Now, okay.
Or maybe I'm talking my own.
No.
View. But
now that you said it, it makes sense. Yeah.
Okay. And even so we're definitely not at a hard landing yet. I think though there are these different waves, right? And we're seeing, there's talk of, are there rolling recessions or sort of sectoral pressure? We're seeing a lot of job cuts, especially in technology. We're seeing it again out of the same sort of Dallas Fed survey on the energy sector, this issue on the one hand of still not being able to get the skilled labor, needing to sort of, scale up. And that's something we hear in some other sectors as well. So I think that's a policy environment that's quite difficult. The downside risks seem greater to me. And I think part of the problem here is that I think the Fed, if anything, the markets may end up being right, but I think that this is going to happen a lot more slowly than they anticipate, and so we're likely to end up with some waves. The other thing I think that is different about this cycle than maybe a couple of the last ones is that China doesn't really have the sort of balance sheet space to do a big credit stimulus, or they've learned from the impacts of their own sort of cycles. And so I think from a global level, this does mean, if not fully a synchronized sort of recession, slowdown, and much weaker recovery than hoped at the time that a lot of governments are getting into these key critical technology and mineral sectors in ways that probably both elevate inflation, but also lead to shock. So it's probably not a hard landing, but we're sort of bouncing around in maybe some kind of a W or U like dynamic. So we'll see how it goes.
The letters, there was a hockey stick a few months ago. I'm not sure where that went, but I'd have to disagree with James on his note just because he wants controversy. So I'm going to have to say, James, I disagree with your statement that the Fed were not spooked. The Fed, it has to be remembered, made a commitment to cover every bank deposit, no matter the level, the insured amount, 250,000. But in the course of one weekend, they essentially said every bank deposit in America is covered, is too big to fail. That to me was the most scariest thing they did in the last few weeks, rather than anything else. And then they came out with their little 25 basis points. But that nonetheless was my view. The Fed rate hike is no longer relevant to the oil markets. You're an idiot, Sean Evers. What are you talking about? 86% disagree. Okay, take it on the chin. Boom. Thank you, guys. Mike McGlone, as always, in Florida. Really appreciate it. Rachel Ziemba in Washington. Osama Rizvi in Pakistan. Really appreciate your comments and insights today. Oil markets, it would appear, taking a pause this morning in Asia, trading at $78, a little changed, not quite getting over that $80 mark after a big run up this week. Maybe they'll get some more oxygen from the bull market and NASDAQ, and that'll lift it the next piece before markets close this week. We will have to see. All the best. Thank you very much.
Thank you.